Hey everyone, this is Adam here at Skyview Trading, and in this video we are going to talk about how stop losses actually do the exact opposite of what they're designed to do, which is help make you more money by limiting your risk. So let's get into it. As premium sellers, we are always placing high probability trades. And as experienced traders, we know that not every trade is going to work out in our favor because as markets fluctuate, our positions can go against us. So a common theory is to use a stop loss order to manage or limit your risk. You know, the classic cut your losses small and let your winners run saying. But listen guys, I absolutely despise the use of a stop loss. And I know this may sound contrary to everything you've always heard, but stop losses will not help you, they will only hurt you. So let's get into a few reasons why I don't like stops. First, let's talk about the stop order itself. A stop order is essentially just a market order, except it's just triggered when the price touches a certain level. So, okay, not only are stop orders bad, but market orders in general are just horrible. Professional traders just don't use market orders, and there is a good reason. When you place a market order, you have absolutely no control over where you get filled. The counterparty can fill you at whatever price they want to. Sure, you might have faster execution, but you're going to pay a big amount for that, especially over a large number of trades. So just take my advice and stick to using a limit order. If you don't fill, you can always cancel and replace the order at a different price. And, you know, I get it. You may be away from internet access, and maybe having a stop order in place just makes you feel more comfortable. And if anything, this should be the only reason you would ever use a stop loss. But still at that, I would highly advise against them, especially when trading options. So I explained why stop orders are bad, but what about the use of a mental stop loss, which is mostly just a mental agreement with yourself that if the stock or option gets to a certain point, you'll exit the position and take the loss. Well, here's my take on focusing on cutting losses in an effort to limit your risk. But first, let me just ask you, if you like a stock to the long side at $50, why would you not like it even more at $45? I'm not saying you double down or anything like that. I'm just saying, wouldn't you still want to have the bullish position? Don't get caught up in the fact that, it could be breaking down or whatever. That's a game that 90% of traders play, and that's why 90% of traders lose money. You'll never time the tops and bottoms perfectly anyways. Now let's get into a more technical explanation about the negative aspects of stops. I've proved in another video that the probabilities given to us in the option chain are very accurate, but let me briefly explain these probabilities for those who haven't seen that video. So there are two probability measures. Probability of a touch is the probability that the stock will touch that strike at some point during the expiration cycle, and probability in the money is the probability that the stock will expire at least 1 penny beyond that strike at expiration. Now, what's important is that probability of a touch is approximately 2 times probability in the money. This is because market direction is a 50-50 bet, which makes sense, right? Because, for example, let's say the at the money strike has a probability of a touch of 100%, because it's at the money, it's already touching. So if the market is 50-50, then wouldn't the probability of expiring in the money be 50%? Right, because it has a 50% chance of going up or down from that level. So just remember, the probability of a stock touching a certain level is double the probability of a stock expiring beyond that level. And guys, I know this stuff is kind of heavy, especially if you're new to this, but if you need to, just rewind the video and rewatch it and think through it, and it should make sense. Okay, moving on. So let's say you sell an option that puts your break even at the probability in the money of 30%. So you have a 30% chance of losing money, and you have a 70% chance of making money. Well, even though you only have a 30% chance of losing money, you have a 60% chance that your break even will get tested. So to put it simply, 50% of all your winning trades will be tested at some point during the life of the trade. Now just think about that. So let's make it simple and say you decide to cut your losses when your break-even stock price is tested. That means your percentage of profitable trades will be cut in half. So if you have a winning percentage of 70%, you now only have a winning percentage of 35%. That's a huge deal. So anytime you go into a trade with a plan of stopping out at a certain point, you're going to be significantly decreasing your winning percentage. On the flip side, anytime you focus on taking profits early, you're going to be significantly improving your winning percentage. Also, let me just point out that focusing on losses all the time is a huge psychological mistake. It will put you in the wrong frame of mind and cause you to make bad decisions and acquire gray hair at a young age from all the stress. Okay, so all of the probabilities and everything make sense, but how do we manage risk then? Well, risk is not managed after you enter the position. It can only be managed before you enter the position through proper position sizing. With a defined risk trade, you know your exact risk when you enter the position, so just size your position accordingly. Now, risk is also managed through a number of uncorrelated positions, and this is covered in a separate video, but this goes hand in hand with position sizing. Lots of small, uncorrelated positions is your best way to manage risk and smooth out your consistency in your trading. So to wrap the video up, I'm not saying there is never a time you'll take the loss and move on. Maybe you need to free up some capital, or maybe you no longer have the same opinion on the stock. Whatever it may be, there might be certain times that it makes sense to take the loss and move on. All I'm saying is that you should not make cutting losses a large focus of your trading. Most people beat themselves up thinking they should have cut the loss sooner, or they took profits too early and the stock kept going. But so what? Because you can't predict any of that anyways. You should be doing the exact opposite. So here are the key takeaways. Number 1, be patient with your losing trades. Number 2, be aggressive with taking profits. 3, trade small enough to have the flexibility to let your positions play out. And lastly, stay active by putting on more uncorrelated positions. Sometimes the best thing to do when you're getting impatient with a trade is to just put on another trade. This will keep you occupied instead of staring at your losing positions all day and freaking out. So, alright guys, hope that helps. If you have any questions, make sure to reach out to me, and I will see you in the next video.